short-term moving average cross above a longer-term moving average, such as 60-day or 120-day moving average, this is called a bullish crossover. So when the short-term moving average cross above a longer-term moving average, it signals a good timing to buy the stock. So this is the bullish crossover. So, this means that the short-term prices are rising faster than long-term prices, which may indicate strengthening upward momentum. There is a strong momentum. Conversely, if the short-term moving average cross below, so MA from above, this means cross below. So when short-term moving average crosses a long-term moving average from above, it means cross below. This is called a bearish crossover, and this may suggest that short-term prices are weakening relative to long-term trends. And one of the most widely followed crossover signals in financial market is the 50-day and 200-day moving average crossovers. When the 50-day moving average rises above the 200-day moving average, it is called a golden cross. So it's a very golden opportunity to buy the stock. And on the contrary, when the 50-day moving average falls below the 200-day, it is called a death cross, meaning there might be a huge downward trend coming. And this illustrates an example of the moving average crossover signals. In the chart, you can see two moving average, a short-term moving average, such as the 20-day moving average, and a longer term, which is the 60-day. At certain points in the chart, the short-term moving average with the red line cross above. The short-term cross above the longer-term moving average. So this is a bullish crossover, so which may indicate the beginning of an upward trend. And later, the short-term moving average may cross below the longer-term trend here, cross below the long-term trend. This is called a bearish crossover. Which may signal a potential downward trend. However, it is important to remember that these indicators, these signals, are not always perfectly accurate. This is the limitation of technical analysis. Anyway, sometimes the crossovers may occur during sideways markets. So when they occur during sideways markets, they may cross below or cross above when the overall market trend is in the box and they move sideways. This generates a false signals. And because of this, many traders combine moving average signals with other technical indicators before making trading decisions. And another widely used technical indicator is the Bollinger Bands. The Bollinger Band is designed to measure a price volatility. And to provide a range within which prices are expected to move. So Bollinger Bands is to measure price volatility and to provide a range which prices are expected to move. So it consists of the upper band, lower band, and middle band, and you expect the price will move within this range. And first there is a middle band, which is simply the moving average of the price. This moving average represents the general trend of the market. And there is an upper band. This band is calculated by taking the moving average and adding a certain number of standard deviation. And third, there is the lower band, which is calculated by taking the moving average and subtracting the same number of standard deviation you apply to a higher band. And the standard deviation is a statistical measure that reflects how widely prices vary from the average. So when the market volatility increases, the standard deviation becomes larger, and the distance between the upper band and the lower bands widens. And when volatility decreases, the band becomes narrower. Because of this structure, Bollinger Bands create a dynamic trading range that adjusts to market conditions. So the band, which is the price range, becomes narrow when the market is less volatile, and the band, the range, becomes wider. It widens when the market becomes more volatile. And technical analysts often interpret this band as representing a statistically reasonable range within which prices are likely to move most of the time. So when price moves near the upper or the lower boundaries, analysts begin to consider whether the market may be overextended. So there is a band, say middle band, upper band, and the lower band. This is the average, moving average, and the upper band and the lower band is the addition or the subtraction of the standard deviation, say 1 standard deviation and minus 1 standard deviation. You statistically expect the price move within this range. So if it touches the upper band, you statistically expect the price to fall back because it reached the upper band. Likewise, if it touches the lower band, you statistically expect the price to move up because it reached the lower band. And it is often used to identify potential overbought or oversold condition in the market, or overbought. When the price moves below the lower band, say here's the upper band, middle band, the lower band, when the price moves below the lower band, it may suggest that the stock is oversold. So it suggests you to buy the stock because it is too cheap, it is oversold. And this means the price has fallen significantly relative to its recent average. So some technical analysts interpret this situation as a buying opportunity, expecting the price to eventually move back toward the average level. On the other hand, when the price moves above the upper band, the stock may be considered overbought. In this case, the price has risen significantly relative to its recent average, and you may consider this a possible signal to sell because it is too expensive and it will likely to fall back to converge to its past average. It is important to remember that the signals are not always perfect predictors of future price movement, however. So you have to look at other indicators to confirm the signals. And sometimes price can remain above, or remain below the band for an extended period, especially during a strong market trends. So for this reason, Bollinger Bands are often used together with other technical indicators rather than as a standalone trading signal. And this is the example of Bollinger Bands applied to a price chart. In this chart, you can see the three key components of the indicator. The middle moving average line, the upper band, and the lower band. Notice how the distance between the upper band and the lower band changes over time. Here is very volatile, and there is a lower gap compared to this one. When the market becomes more volatile, the bands expand outward. When the market is volatile. This reflects the larger fluctuations in price, and when volatility decreases, the bands move close together, indicating that price movements are becoming more stable. So you may also observe that the price sometimes touches or break through the upper or the lower band. A breakthrough or reaches the upper band. This often attracts the attention of technical analysts because they may indicate overbought. Here is the oversold. And here may be overbought conditions. As I mentioned earlier, however, those traders usually combine Bollinger Band with other indicators or chart patterns before making trading decisions. So far, we have discussed several price-based indicators such as moving average and the Bollinger Bands. However, one challenge when using price-based indicator is that it sometimes be difficult to determine whether a price movement is truly unusual or simply the part of normal fluctuations. To address this issue, technical analysts often use momentum oscillators. Momentum oscillator focus on the rate of change in prices rather than the price level itself. So it's rate of change in price data. And these indicators measure how quickly prices are rising or falling. So how quickly the prices are rising or falling. And by examining the speed of price changes, you may detect a potential turning point in the market momentum. So momentum oscillators are usually scarce, so their values oscillate within a fixed range, typically between 0 and 100. Because this indicator moves within this range, it becomes easier to identify extreme conditions, such when price may have risen too quickly or fallen too rapidly. And one of the most widely used momentum indicator, the oscillator, is called the relative strength index. The relative strength index, commonly called a RSI index, is one of the most popular momentum oscillator used in technical analysis. The RSI is designed to measure whether a stock may be overbought or oversold. The calculation of the RSI is based on the ratio of total price increases over a selected number of periods. In other words, the indicator compares the magnitude of recent gains so they compare the level of the degree of the recent gains with the degree of the recent losses. Degree of recent losses. And the RSI value is scaled between 0 to 100. And when the RSI value is high, typically above 70, the market may be considered overbought. So if this number is greater than 70, it is considered the stock is overbought. This suggests a signal to sell the stock because it's overbought. This means that the price has risen rapidly and may be due for a correction. On the other hand, when the RSI value is low, typically below 30, the value of 30, the market may be considered oversold. This suggests that the price has fallen significantly and may potentially rebound. So this suggests a good opportunity, good timing to buy the stock, buy signal. Because the stock is oversold and too cheap. And it is important to remember that like the other indicators such as moving average and the Bollinger Band, any technical indicator alone are not perfect predictions. So you have to look at other indicators and combine the signals to derive your investment decision. So you do not really look at this indicator alone. You look at the moving average, Bollinger Bands, a relative strength index together to make your trading decision. And this is the example of the relative strength index plotted together with a price chart. Here is the RSI. If you use the home trading system or the mobile trading system to trade your stock, there is a technical option to include the volume chart or the other technical indicators. You can choose the RSI option and it will display you these values. So here is the price movement and below is the RSI indicator. So it moves between 0 and 100. So this is 20, here 20, 80. And when RSI above 70 here, the market may be considered overbought. So it suggests you to sell the stock. And when the relative strength index falls below the value of 30, the market may be considered oversold, suggesting you to buy the stock. By observing these signals, technical analysts try to identify moments when price momentum may be weakening or reversing. As I mentioned several times, just like other technical indicators, these signals are used together with other tools rather than as a standalone trading rule. And not all technical indicators are based directly on price movements. Some indicators try to measure investor sentiment, which refers to the overall attitude of investors toward the market. These are known as sentiment indicators. A sentiment indicator tries to capture whether investors are becoming optimistic, say bullish, or more pessimistic, known as bearish. One well-known indicator, sentiment indicator, is the volatility index, commonly referred to as the VIX index, VIX. The VIX is calculated by the Chicago Board Option Exchange, or the CBOE VIX index. This measures the expected volatility of the S&P 500 index over the next 30 days based on price of options on the S&P 500. In simple terms, the VIX reflects how much investors expect the market to fluctuate in the near future. So this shows, the VIX shows how much investors so this reflects the investors view on the S&P 500 index in the future movement. Because volatility tends to increase during periods of uncertainty, the VIX is often interpreted as a measure of market anxiety or stress. So if VIX increases, it indicates that investors' fears are increasing. So therefore, the VIX, or the volatility index, is sometimes called the fear index. This is because the level of VIX tends to move inversely with the investor confidence. During bull market, investors are optimistic and market conditions appear stable. So the VIX tends to remain relatively low. However, during bear market or the periods of financial stress here, 2008 global financial crisis, the VIX often rise significantly. This increase occurs because investors expect greater uncertainty and larger price fluctuations in the market. Therefore, this VIX index rises sharply, and it is often considered as a sign that fear and uncertainty are increasing among investors. For this reason, the VIX is frequently monitored by traders and analysts as an indicator of the overall market sentiment. So if the VIX value rises, it shows that investors are getting uncertain or getting more fear, meaning there is some shocks coming to the market, or the investor sentiment is low. They're not bullish, they're bearish on the future market movement. All right, Lastly, there are two approaches for stock investment. You can either fundamentally or technically analyze the stock to make your investment decision. And fundamental analysts use either a top-down or bottom-up approach to pick stocks by estimating its intrinsic value. Top-down meaning is to you first analyze its macroeconomic condition or industry, and lastly you analyze the firm's fundamentals. So you begin from the top. So this is called the top-down approach, and the bottom-up approach is to firstly analyze the firm valuation. Those two approaches are almost similar, but it has some important difference in that the top-down approach more focus on the macroeconomic analysis. Instead, the bottom-up approach more focus on the firm fundamentals. Anyway, they try to pick stocks by estimating its intrinsic fundamental value based on firm's fundamentals, say future expectations of the firm earnings, or the macroeconomic conditions. On the other hand, the technical analysts do not try to estimate its intrinsic value. They just try to analyze the past patterns to predict the future trends. And technical analysis is a trading discipline employed to evaluate investment and identify trading opportunities by analyzing statistical trends gathered from trading activity, such as price movement and volume. And unlike fundamental analysis, which try to evaluate a stock value based on business results, such as revenue or earnings, a technical analysis focus on the study of price and volume movement. And technical analysis try to analyze the supply and demand for a stock, for a firm, which the changes in price and volume and the implied volatility. And the technical analysis operates from the assumption that past trading activity and past price changes of a stock can be a valuable indicator of the stock's future price movement when paired with appropriate investing or trading rules. So basically, fundamental analyst means that markets are at least weak form efficient, and technical analysts believe that the market is not inefficient, because they try to benefit from analyzing the past information. And the technical analysis is often used to generate a short term. So fundamental analysts focused on long-term goal, long-term target strategy, while the technical analysts try to benefit by trading in the short term. So they try to generate short-term trading signals, indicators from various charting tools, say chart patterns or the technical indicators. But technical analysis can also help improve the evaluation of a stock strength or weakness relative to the broader market or the industry or the sectors. And this information helps analysts improve their overvaluation estimate. And in the real world, there are hundreds of trading rules, hundreds of price and volume patterns. And across the industry, there are hundreds of patterns and signals that have been developed by researchers to support technical analysis trading. So technical analysts have also developed numerous types of trading systems to help them forecast and trade on price movements. And some indicators are focused heavily on identifying the current market trend, including support or resistance areas, while others are focused on determining the strengths of a trend and the likelihood of its continuation. So commonly used technical indicators and the charting patterns include trend lines, the moving average, or channels, or momentum indicators. In general, technical analysts look at the common broad types of indicators such as a price trend, the chart patterns, the volume and momentum indicators, oscillators, moving average, support and resistance level. Anyway, which do you think is better? Do you believe in fundamental analysis or do you believe in technical analysis? As I mentioned several times, there is no answer. No answer. We don't know which one is better. I don't know the true answer. But in my personal opinion, I suggest to use both. So try to use both. I would suggest you to make your decision based on the fundamental analysis. So pick undervalued stock based on the firm's fundamentals and use the technical analysis to time the market. So use fundamental analysis to value the stock and to pick the undervalued, the cheap stocks. And when to buy these pick stocks, try to use the technical analysis to time the market, timing the market. So when is the right timing to buy this cheap stock, this undervalued stock? Or when is the better timing to buy or sell those stocks you pick using the fundamental analysis? So I would like to say the technical analysis may complement the fundamental analysis by timing. So this helps you to timing the buy or sell decisions you derive from the fundamental analysis. So that's my personal opinion. For instance, suppose you're a fundamental analyst and you believe that a particular stock is undervalued relative to its intrinsic value. So based on your fundamental analysis, you may decide that this stock represents a good investment opportunity. However, even if a stock is undervalued, it does not necessarily mean that the price will increase immediately. So this is where technical analysis may be useful. So technical indicator and the chart patterns may help investors decide when to enter the market. In other words, technical analysis can be used to help time the buy or sell decision. So for instance, you might wait for a technical signal indicating upward momentum before buying the stock. So by combining both approaches of fundamental and technical analysis, you can try to improve your investment decision-making process. So I suggest you to use both analysis and to pick undervalued stock based on the firm fundamentals and time the market based on the technical indicators. That will be the optimal strategy. And finally, if you're interested in learning more about technical analysis, there are several short educational resources available. I picked 2 short videos that explain the basic concept of technical analysis. The first one is provided by Fidelity, introduces the basic ideas behind technical analysis and how traders interpret charts and indicators. The second one compares the fundamental analysis and technical analysis, help you understand how these 2 approaches differ and how they can complement each other. And each video is relatively short, I guess less than 10 minutes, and provide a very valuable overview of the concept we have discussed in this lecture. So if you're interested in exploring technical analysis further, this can serve you as a useful starting point.